Hey there, this is BK from Forge Crypto Trading. Today we're going to be talking about how to manage risk to reward, how to calculate risk to reward, the importance of a trading plan, and my Forge philosophy, so you can end the circle of losses and enter the circle of bosses. So let's get it in. Alright, so first things first, what is a trading plan? A trading plan is a roadmap of how to trade. No trade should ever be taken without a trading plan first in place. A trading plan answers the question of why. A trading plan includes an entry, targets, and a stop loss. Not only are these required, but the reasons to why are also required. If you cannot answer these questions, just do not take the trade. It is not worth it. You're going to lose your money, and just do not do it. Have a plan. It's number one priority. So my 4-edge philosophy, that basically means that a minimum of 4 edges are required to enter a trade. So what exactly is an edge? So when you go to a casino, the casino always has the edge. And our goal as a trader is to trade like a casino and be just like a casino and trade with an edge. A minimum of 4 edges to be precise. So now I'm going to define an edge. What is an edge? RSI divergence, MACD divergence, previous supports and resistances being respected, well-matured chart patterns, the trend which is your friend to the end. Never go against the trend. That's the number one rule. The trend is most important. Simple moving averages. You want to have all of these on multiple time scales. The 1 hour, the 4 hour, the daily, and the weekly is what I personally use. You want to have it at least 2 or 3 of these. Now the daily and the weekly, that's what I use to find my chart patterns, because the more significant the time scale, the larger the time scale, the more significant the pattern is going to be, and it's going to hold much more weight. Now the 1 hour and the 4 hour, that's where I look for divergences, also on the daily and the weekly as well. But I also look for entries on the 1 hour and the 4 hour. That's the best spot to do that. You never want to go under the 1 hour. Even the 1 hour is pushing it. I personally like the 4 hour the most for this specific reason. So here's an example of a trade that I took with a trading plan example so you can see what one should look like. So first we entered BTC to the USD, $29,507 with a stop loss of $26,923 and a take profit of $44,254. Now our risk to reward in this situation was 6 to 1. So that means we have to win 1 in 6 trades to break even, and anything after that is profit. Now you never want to go under 4 to 1 because that's just putting way too much pressure on yourself, and it's hard to win that many trades. So just be very mindful of that. Next we have our reason for entry. So we had bullish divergence on the 4 hour MACD and the RSI. So what is the MACD? That stands for moving average, convergence, divergence. And it shows negative momentum, the red histogram islands, and positive momentum, the green histogram islands. So when you get divergence, what that means is you have 2 different lows. On the first low, you make high levels of negative momentum, and you make a lower low, so the price goes lower, but yet you have less levels of negative momentum. So it's contradicting the price or diverging from what the price is doing. So that's what bullish divergence is. And on the RSI, which stands for Relative Strength Index, that basically shows us overbought and oversold. When it goes up, it's overbought. When it goes down, it's oversold. And divergence works the exact same way on that. You have your first level. It's lower than your second level, even though the price is diverging from them. So that's our second edge. Our third edge is the falling wedge pattern, which is a very bullish pattern. Highly suggest you look into it and apply it in your own trades. Our next edge is the double bottom. So you have one bottom and the second bottom. That would be another edge. Then another edge we had on this trade, which I unfortunately don't have the chart up, but on the daily chart, there was hidden bullish divergence. So our profit taking level is decided by the measured move of the falling wedge. So what we do for that is you measure the bottom of the wedge to the top of the wedge. You put it right to the breakout point, and you get about an 11K move up. Now, it's not always going to be exact, but it's going to be pretty darn close every single time. As you can see, it was like pretty close to that point. And it works both ways. You could also have a measured move down, which is why you want to have a stop loss. And the way we determine our stop loss is by putting it just under the support of the falling wedge. So this line here. If it breaks under that, you want to get out of the trade and protect yourself. So always trade with a stop loss, because without a stop loss, you really just can't sleep at night, especially in a market like crypto where it's 24/7. You got to have the stop loss. So next I'm going to show you how to calculate your risk to reward and what it is. So risk to reward is the ratio used as traders to find out the potential reward for each dollar risked in the trade. Risk to reward is important because without knowing the risk, we are trading blind. And we ain't Stevie Wonder, we ain't Ray Charles, we ain't here to do that. We want to see what we're doing and know our risk and our reward ever before entering a trade. That's super, super important. You never want to risk more than 2% of your total trading capital per trade. And to calculate the risk to reward, we must know the dollar amount in our account, the percent we are willing to trade, or the percent we're willing to risk, and the percent loss in the trade determined by our stop loss. Now in this example, our total trading capital is $10,000, and what you do is multiply it by the percent we are willing to lose, which is 2%. And I always recommend never going over 2%. You can use 1% if you're a little bit more conservative, but I personally use 2%, and it's worked great for me. So if you do this equation here, 10,000 times 0.02 or 2% equals $200. Now that's the dollar amount that we're able to lose to only be risking 2% of our $10,000 trading account. So what you do after that is you take that number and you divide it by the stop loss percent, which in this case was 7.5% or 0.075. Now it's going to give you the position size that we can take to only risk 2% of our account. And you always want to use the currency that you're trading in. And in cryptocurrency, it's always United States dollars. So don't trade to your native currency because everyone else in the world is going with USD. So that's very important to know as well. So let's go over this again. $10,000 times 0.02 equals $200. You take that $200 divided by 0.075, and that gives us the position size of $2,666.66. Now all you have to do in your trades is plug in your own numbers, your trading capital, the percent stop loss, and then, the percent that you're willing to lose, which is 2%, and then your percentage of the stop loss divided by that number. And you'll come up with the position size. All right, well, this has been BK from 4Edge Crypto Trading. Don't forget to like, subscribe, comment below, and join the Discord if you want more information, because I'll be more than happy to help. All right, BK signing out. Peace.